This week has been interesting because we haven't had a lot of corporate news out, but it was futures closeout, so that's quite significant.
Yesterday, I mean, you didn't see the market do too much yesterday, but what was interesting is that later on in the afternoon, SA breweries came under big pressure, and it was just down 2%, and there was no news, there was nothing that would make it do that other than the futures closed out. But it was relatively an uneventful day, other than the one, as I said, the SAB that I picked up.
So SAB is up around 6/10 of a percent. Is it a buy for you, 313 rand?
No, it looks expensive. Okay. Now, we were having a quick look at the valuation of Anglo-American versus SAB. SAB is 3 times more expensive than Anglo-American, and it's only been at that level, I think, twice in the last 20 odd years. So it looks very expensive relative to Anglos. In other words, either Anglos is going up or SAB is going down relative to each other. It looks very, very
So you're
extended.
buying Anglo-American, it's up around 2% today, sitting at 314 rand
Anglo wasn't too bad today, Bulletin wasn't too bad, but you know, as you showed, it's a very flat day overall.
Pretty much. Okay, so Investec.
Yes.
So for some time now, and at these quarterly updates that we see coming through, pretty much flat performance, and now suddenly just earnings down around 18% or so.
No, this is a very, very disappointing number for the market. Now, we have been told from numerous sources, including our internal sources, that Investec just looks cheap. If you normalize the return on capital or you normalize their earnings, share looks massively cheap. The only problem is it keeps disappointing on results.
But would you be
for
saying
a long time?
Aren't they bedding down a lot of the acquisitions that they made over the period?
But they've made these acquisitions a long time ago. I mean, there's no major big acquisition other than the asset management side. So.
But it is in the UK and it is in a depressed market, so perhaps
exactly the problem. They've still got bad debts and stuff like that. So, you know, the share does look very cheap, but the earnings keep disappointing. Now, when these results came out, the share got caned.
And it's flat, still slightly to the negative today. So you're saying it's not a buy? Is it too risky for you?
I just, I suppose you've got to hang your hat on long-term valuations, and you've got to say they will eventually get back to much higher return on assets and return on equity. So I suppose the answer is yes, you should be buying it, but you might wait 2 or 3 years until you get payback on it.
But I mean, if you see relative to the retail banks, and of course you can't really compare because Investec is an investment stock, would you say that, I mean, if you look at the overall financial and banking sector, which would your stock picks be? What would you want exposure to? The actual consumer and not so much
the answer was very easy a couple of months ago, and that would have been one of the mainstream banks. But these banks have run very, very hard.
But a lot of these banks also have investment arms, and it seems that they're not doing that badly, though.
But look, Investec, very different to the normal main high street SA bank. The Australian side now, the story is that they're going to clean out every last cupboard in the Australian thing, and next year there'll be the improvement. So they've written off everything, taken all the provisions in Australia. So maybe next year that looks better. I suppose if you take a longer view, Investec might be one of the better buyers in the banking sector, but only because the other banks have run, and secondly, you might wait a long time to get payoff on this one. This share, Investec, has underperformed for a sustained period now, long time.
It's unbelievable because we've actually almost put the first quarter of 2012 behind us. So is it time to rebalance your portfolio, to actually look at the construction shares, to move out of industrials into resources? What would you be doing right now?
On exactly the same theme as we were talking about earlier on, the same applies for the banking shares versus the industrial shares. The relative price of the shares looks very, very extended towards industrials. So I suppose you should be selling some industrials. I mean, the simple ones are sell some ShopRite, sell some SAB, Naspers I'll still keep, maybe lighten some Richmond and buy some mining shares, buy Anglos, buy Bulletin. The banking shares, I think you've got to start taking profits now. There's been a very, very hard run there. And maybe on the all-share index, if you were lucky enough to be overweight, maybe also take some profits there. Although there's no immediate danger that I can foresee in the all-share index, simply because it's not that expensive. But also, you've made the easy money now. The easy money from a low valuation has already been made. So maybe it is time to rebalance. The one thing that I've been harping on for a long, long time, I mean, probably a year now, is how expensive US government bonds are. At long last, that yield is going up.
We actually saw a big sell-off this week in the US market.
And so the US bond was below 2% for a long time. Now it's about 2.2, 2.3%. So there's been a big sell-off there. I think it's going to continue. So at least, by the way, that's actually good news for equity. Yeah,
exactly.
Point,
I mean, the money's got to go somewhere.
And
apart
that's
from
good
that,
news for equity.
US Treasury is always deemed as a safe haven play.
Yeah.
Now perhaps we're seeing a bit of a
and
better sentiment playing out.
The environment has changed quite considerably from at the end of last year. End of last year, people were incredibly negative, unjustifiably so, as it turns out. But the US bond moving up actually tells you that some form of normality is being restored to the world's markets. I don't think it's going to stop before 2.5 or 2.6% on a 10-year bond. So it's still a long way to go, but at least that is coming right now. And that actually is good news for equity markets and the world's economy.